Hello friends, welcome back. In this session, we are going to discuss one of the most important ratios in the financial market, that is price to earnings ratio. So let us begin our lecture 5, price to earnings ratio, ratio number 1. Now let us understand what is PE ratio. PE ratio stands for price to earnings ratio. P ratio is price to earnings ratio. So P ratio is used for valuing a company. So it measures its current share price relative to its earnings per share. So P ratio is nothing but market price of that company divided by earnings per share. As you all know, earnings per share is PAT, profit after tax, divided by total number of shares. So what does P ratio tells us? P ratio is used for valuing a company amongst the sector peer groups. Other names for the price to earnings ratio is price multiple or earnings multiple. So now let us understand PE ratio by an example. So let us take an company ABC, which is having the current share price to be 1000 rupees and the earnings per share is rupees 50. So in this case, the PE of that company is current share price divided by earnings per share. So that is rupees 1000 divided by rupees 50, that is 20. So now the company is having a PE of 20. What do you understand by the meaning that the company is having a PE of 20? It means that you as an investor are ready to pay 20 times more than the company's earnings, which means that you are ready to pay 20 times more than the company's earnings per share. So are you mad to pay 20 times more? It does not work like that. So you are having confidence on that company that one day the company's profit or the earnings per share will surely increase and it will yield you more returns. So PE is sometimes a positive sign, and it also tells us whether the company is overvalued, undervalued or fairly valued. Now let us see the valuation of PE. PE is one of the most widely used stock analysis tools used by the investors and analysts for determining stock valuation. So let us see the analyzation part of the PE ratio. In general, a high PE ratio suggests that investors are expecting higher earnings growth in the future compared to companies with lower PE. This means that the investors are ready to pay a premium amount, some amount more than the earnings that company is yielding you now, expecting higher earnings growth in the future. A low PE can indicate either that the company may be undervalued currently or that company is doing exceptionally well relative to the past trends. So we are having two scenarios here. One thing is that the company may be undervalued if the company is having a low PE, and the second is that the company is exceptionally doing well relative to its past trends. So exceptionally doing well means the company's profits are increasing. If the profits are increasing, then the earnings per share will also increase. Keeping the share price to be constant, then the PE ratio of this company will surely decrease. So there are two scenarios if the company PE is low. One thing, the company may be undervalued. Second one is that the company is doing exceptionally well relative to its past trends. When a company is having no earnings or posting losses, in both cases PE will be expressed as not available, though it is possible to calculate a negative PE. This is not a common convention. Note, PE ratio should always be compared with the peer groups of the same companies. You should keep it in mind that PE ratio should always be compared with the same companies of the same sector. Now let us take some live examples. I have taken Hindustan Unilever Limited, which is one of the leading companies in the FMG sector, a market leader of having a market cap worth more than 5 lakh crores. As you can see on your screen, the PE of Hindustan Unilever is 70. Now let us take another example. a leading bank in the banking sector, HDFC Bank. As you can see, it is having a market cap of worth more than 7 lakh crores. The PE of HDFC Bank is 25. So you can say that PE of HDFC Bank is low, so the company is less overvalued, and it is like fairly valued, and you can buy the stock. It does not work like that. As I told you, you should always compare companies with the same sector. Hindustan Unilever, when compared with its peer group, it is having a PE that is equally or like in the same range. As you can see, Dabur is also having a PE around 70. Even Godrej Consumer Products are also having a PE around 70. So you should always compare PE with the same sector companies. The same goes with the HDFC Bank also. HDFC Bank is having a PE of 24.59, whereas ICICI Bank is also having a PE of 25.52. So same goes with the Kotak Mahindra Bank also, Axis Bank also, Indus India Bank and Bandhan Bank. So this is all for today. Please like, share and subscribe our channel. Thank you one and all.